Morning, friends. So, this is your facilitator, Rajat Kush, and we are going to cover Treasury Insights for non Treasury staff. These are the learning outcomes for this course. In the first module, which is this one, we are going to cover the basics of Treasury. Okay. In the second module, which is further subdivided into few more modules, we are going to discuss about the organization and structure of a treasury in a bank. In the third module, which will further be divided into some sub-modules, we are going to figure out what are the different functions which are performed by the bank's treasury. In the fourth module, we are going to discuss the controls and the limits which have been put in place to manage risk in the bank. So let's start our module number 1. Basics of Treasury. In this module, we are going to focus on these two aspects for the treasury. First of all, understanding what treasury actually is, and then the most important pointers for treasury in a bank. So let's start with topic 1, treasury in a nutshell. So what exactly does a bank's treasury do? First, they try to control and manage the bank's money. That is the first priority for any treasury in a bank. And this thing is managed by how you have designed the structure of your treasury department itself. Then the second is treasury in a bank is responsible for liaising with bodies that regulate the banks, your central bank, the norms, Basel norms, whatever norms are applicable on a bank. All these requirements which are coming from the central bank of UAE, your treasury department makes sure that a bank fulfills all these requirements. Third, bank has a team which we call as ALCO, Asset Liability Committee. Now, first of all, let's understand that what kind of risk a bank faces. Now, bank can face a market risk, operational risk, credit risk. There are a lot many risks a bank is facing. The biggest risk for any bank is asset liability mismatch. Now, your assets are the loans which you have given. Your personal loan, your car loan, home loan, other kind of loans which you have given, these are the assets for the bank. The liabilities for the banks are all the deposits you have taken, all the monies you have taken, okay? Current account, savings account, fixed deposit account, okay? Now these assets which you have usually longer term duration compared to the liabilities of a bank. So this team ALCO is there to manage this mismatch. You cannot remove it. You cannot just match loans with liabilities always. There's always going to be a mismatch. So this team is responsible for managing your asset liability mismatch, and it is part of your treasury. The last is meeting institutional and corporate customers' investment, okay, and risk coverage needs. Now, in a bank, sometimes we create our own product, like structured product, to either for the retail clients, or we are creating something for the corporate customers. Okay, we are looking at their investments, we are looking at their risk. We first of all understand what is the risk our client is ready to take, how much risk they are comfortable with, and how much return they are expecting. According to their risk return profile, we suggest different kind of products to these clients. So in a nutshell, you see that the structure, the Basel, the ALCO, the products, everything falls under the purview of your treasury department. Now the second point is what other things your treasury is doing. Now, it is a general belief that your treasury is mainly responsible for your profit generation, but that's not always true. Okay, because if you look closely, your treasury is doing cash management. Okay, they're doing working capital management for the bank, they're doing cash management there for the bank, they're doing fundraising for the bank. Okay, so whenever they find that a bank requires money, okay, and they require money for a long time, you want to do an IPO, or you want to do FP, or you want to issue bonds, okay, it is your treasury department who is there to make sure that all the funding requirements of your bank are taken care of. Then comes your investments. As a bank, you are making a lot many investments, either with bank's own money or with the client's money. Okay, you are dealing in foreign exchange, you are either speculating in the foreign exchange market, you are hedging, using this market for hedging purposes or for different purposes, but Bank is a market maker in foreign exchange. Now, what is the role of a market maker? If bank do not exist, this market does not exist at all. Okay, so you have to understand that banks are the market maker in foreign exchange. Then banks are definitely doing loans and deposits. Any institution which is not doing both these things cannot be called a bank technically. Okay, then banks are investing in debt securities as well. When I say debt securities, I do not mean only long term, okay, like bonds. We also invest in treasury bills. Sometimes banks get into repo transactions with central banks, reverse repo transactions, sometimes with each other as well. So all these fixed income securities fall under your debt securities. Now you should not be surprised that bank also deals in commodity products. Okay, we usually do not take delivery of these products. Some banks do, so I'm not saying that we never do that, but delivery percentage for commodities is quite less. So we mainly get into this market for our clients, because our clients are, for example, Etihad Airways, right? So now Etihad Airways wants fuel from ADNOC. Okay, so they want to hedge this risk. They want to hedge this risk of rise in fuel prices. So they might approach a bank and they will request the bank that, can you help us out in hedging the risk for the oil? Now, when I say hedging the risk for the oil, hedging means trying to mitigate the risk, trying to bring it down. You cannot always eliminate it totally, but you can always bring it down. And for these kind of stuff, we use derivatives. Okay, I will not go deep down into explaining what are derivatives. These are sometimes being called a complex product, but derivatives are basically contracts. Okay, a contract which is going to expire in future, and the value of this contract depends on the value of some other underlying asset. So mainly for hedging purposes, we use derivatives. So we can use derivative for foreign exchange market, for commodity market, debt market, equity market, for any kind of market. Okay, so all these investments are also looked after by your treasury department. Then comes your risk management. Okay, so cash is done, cash management is done, investment is done, but both these things carry some amount of risk. Okay, who is going to handle this risk? Okay, your liquidity risk, that bank doesn't have enough cash, right? You know what is a bank run situation? A bank run situation is a situation where many depositors have withdrawn money from the bank and bank is facing liquidity risk. They do not have enough cash. It is the responsibility of your treasury department to handle your liquidity risk. Okay. Similarly, your treasury is also responsible for hedging or managing your liability risk, exchange rate risk, credit risk, and regulatory risk. Okay. Do not worry about this stuff as of now. Okay. We are going to dive a little bit deeper in explaining all these different risks being faced by the bank, okay, and how Treasury tries to manage this risk. But we are not going to dive very much deep because this is supposed to be a very basic course. So we are going to stick with the basics, okay? So you, as of now, you just need to understand that besides making money for the bank, Treasury is also responsible for cash management, and Treasury is also responsible for your risk management, okay? So if I have to conclude this topic, I would say treasury is the backbone of a bank. Okay, without treasury, I don't think banks can work. Now, this can be said with for any department, be it your loans department or your RMs. Everyone is important for a bank, but somehow treasury seems like a backbone of the bank. It is involved in managing investment. We covered that in the previous slide. Okay, so this investment is either proprietary, which is using bank's own money to do investments, or using client's money. Okay, and based on or behalf of the client, treasury is making some investments. Besides managing investment, it is also responsible for cash and liquidity management, right? So cash management and risk management. So treasury is doing all these three stuff. Managing different kinds of risk, okay, liquidity, your market risk, your currency risk, all falls under the purview of your treasury. Okay, so I'm going to end this module here, and in the next module, that is module 2, we are going to understand the structure and organization of the bank's treasury.